Guys, we got a mounting problem in the economy and it's time that we address it. So let's dive in.
Trade Genius.
Hey guys, welcome to another Trade Genius podcast. Philip here. Bob has a day off. So we're going to dive into a mounting problem that's been going on, and that is our credit card debt. The numbers came in, credit card debt jumped 18.5% and hit a record 930.6 billion. So this is a big problem, and it's a big problem because as this grows, so will the delinquencies that come down the line. And that's going to be a problem for the banks. And I think what we're going to see coming down the pipe is that banks may be leaning toward hoarding cash or not spending cash or putting it out in the market that we're used to, because this is going to become an issue down the line. Jumping to the next slide here, total credit card debt reached a record 930.6 billion in the fourth quarter of 2022, according to the latest credit report from TransUnion. As balances rise, so have delinquencies, which is something to watch, says TransUnion's Michelle Rainery. So again, if we go over to the next slide, you'll see the credit card delinquencies. Now, while it's not really a huge issue now, you can see the trend here going up into 2022 is on the rise. And I suspect that it's going to get worse. And to really drive that point home, you want to take a look at this debt trajectory chart. This is telling us that the only reason why we're really spending is because we're driving up our credit card debts by and large. Obviously, not everyone does that, but by and large, America is doing that. And you can see when we got into 2020, right? So COVID happened. Isn't it interesting how the credit card debt dropped during COVID? Well, you have to think about all the money that was printed, right? If you remember the liquidity charts that we show you guys, all the money printed was given to everybody. A lot of the money that was handed out, loans and things like that, were forgiven. So basically, people had a bunch of money they could use to pay down debt, or use the money that was given through the COVID subsidies to, spend on things. So they weren't driving up the credit cards. But notice when all that went away, and as we progressed towards 2022, now we started driving up credit card debt. So, we have an addiction to spending, obviously, in this country, but without proper growth, okay, we're spending over our means, and this is going to become an issue. I mean, the credit card debt trend there is ridiculous. And you can see without massive government stimulus, we're just spending over our means. This is a big problem, and it's really going to rear its ugly head for the banks. And so what that means is if the banks are having to deal with this, that means things like the stock market and whatnot are going to have a problem going up, because they're not going to be putting liquidity into the market. They're going to be dealing with massive credit card default on their balance sheet. Speaking of the market, let's jump over to this next chart where we're going to see some things that are telling us that this bullish run may take a breather. All right, so basically what I have here is an inverted put-call ratio chart, and I invert it because it makes it look more like an oscillator, where if the reading is kind of high, you're looking for a break in the price action, and then if the reading's low, it's bullish. So reading high, bearish, reading low, bullish. And you'll notice that we had another really high print this last Friday, Thursday into Friday, and that is on par with what we saw back here in November, which we saw some initial market weakness, some gyration, and then a larger pullback into December. We also got that in August, the same reading, and that was a bear rally high. Big pullback from that into our most recent bear market lows. Prior to that, we had a reading similar area in June. June saw a steep drop. And then before that, we had one in March as well that also saw a steep drop. So definitely a warning signal here as far as how high the put call ratio got. The other thing to understand too is that we saw a ton of volume as we got into the end of January on the put call ratio, which was like some of the biggest call volumes we've ever seen. And if we move over to this slide, you'll see that we had over 2.5 million calls. That's the first time we've gotten a reading like that since November of 2021. And if you recall, that was around the highs of our bull market. What's interesting about this is that the forward returns from such a reading over 5 days is negative 1.37%. And over 10 trading days, it's negative 2.12%. So what does that mean for us? Well, that print was actually when we were trading at 40.80 on SPX. Now, we bolted higher than that, but if we look on the chart, right, you'll notice here, if we take about 2%, that would take us all the way down to about 4,000 on the SPX. So the statistics are telling us there could be a pretty decent pullback even down to 4,000 over the next few days as we progress towards Friday. Now, keep in mind, Powell's speaking tomorrow. It'll be interesting to see if he tries to come out swinging, because if he was trying to be hawkish on his FOMC announcement, the market really didn't interpret it as such and bolted up to about 4,200. So tomorrow we have to watch and see what he says. However, if he comes out swinging and tries to reiterate that we're not out of the woods and the Fed's continuing to be hawkish and maybe they're going to raise rates even more, then we could certainly see 4,100 break down on SPX and push down. This would also affect things like crypto and Bitcoin. Bitcoin probably going to test the 22 level, and breaking below that would probably bring the 21 level into play. And just a reminder, again, our fair value reading hit euphoric levels. Most of the time when we've seen that in this bear market, we've had a big pullback from those levels, okay? Because liquidity is what matters in this market. We had one reading here where we didn't dump. That was at the year end, and the banks typically will pull money out of the market for the year end print and then put money back in. So we had a little bit of a false reading there during that activity. Otherwise, normal operating procedures, whenever we get this much of a print we're extended over fair value, basically relative to liquidity, we are looking at a larger pullback from those conditions. So a little bit of a market update, a little bit of a heads up on the credit card debt issue that I think is going to continue to put pressure on these banks. And if these banks are feeling under pressure, they will take more liquidity out that's available to the markets and hoard cash or park it at the Fed overnight instead of exposing it to the market. So it's just things to think about as we progress forward in this market. Again, we have Powell tomorrow, and then we'll see where things go from there. Obviously, this market's looking ahead to the big CPI print on next Wednesday, I believe it is. So we'll see if we get a trend into that up or down from here. But it looks like down is the more probable course. And again, this is going to affect everything, not just the stock market, but it'll affect things like cryptos and metals and possibly some of the commodities as well, like oil. So there you have it. Hope you guys enjoyed this. Please hit like and subscribe. It really helps us out. And we will see you on tomorrow's video. Take care.
Trade Genius.